Hello, everyone. Welcome to this Investing for Beginners seminar. Today, we'll talk about how you can get started, especially if you are a college student or young professional, to start preparing for your long-term saving needs, such as retirement or any other long-term. So, how to build wealth and achieve financial freedom. So before I begin, I want to show you a legal disclaimer as this is not an investment advice. And we all know this information is only for information purpose only. And of course, investments have risk. So there are risks associated with investing in securities. So I will pause for a few seconds. I would want you to kind of read this disclaimer and then we can start on our presentation. Okay, let's get started. So first, why building wealth matters. So of course, we all know that it's important to have wealth, especially for our in the future. And then of course, so what if you could wake up one day and not worry about bills, job pressure, or financial emergencies? And this is why we need to make sure we are working towards building wealth. That's what wealth building is really about. Freedom, not just money. So what is wealth? Wealth doesn't mean being a millionaire. It means having enough saving for emergencies, earning through investments while you sleep, not depending on loans or credit card for basics, and being free to choose where you love and not work at all. And this is especially important, especially in your retirement years. In simple terms, wealth is when your money works harder than you do. So I just want to have a little, information sharing about the concentration of wealth in the United States. So as you can see from this picture, from this graph, the top 1% of household own around 30.8% of wealth. And if you look at top 50%, they own about 97.5% of total wealth in the US. And the bottom 50%, as you can see here down here, they only own 2.5% of wealth. So as you can see, there's a huge disparity of wealth concentration. The top 50% having around 97.5% of wealth and the bottom 50% only having 2.5% of wealth. So it's a choice where we want to make sure we are where we want to see ourselves. So if you see the secret formula, where's the wealth concentration? What is the secret sauce of the top 50% owning 97% of wealth? And if you look at the portfolio, you'll be amazed that top 50% have large equity shares, means they own either the stocks, bonds, or any other that actually have appreciated in value. So as you can see here, corporate equities and mutual fund shares, again, whether looking at top 0.1% or any other wealth groups. And if you look at the top 50%, they have got larger equity shares compared to bottom 50%. And bottom 50% have got very, very small share of corporate equities, means having ownership in stocks or any other securities. So this is something which we have discovered that owning stocks have actually significantly impacted wealth ownership. So now that we have seen that the top 50% have got larger portion of corporate equities or mutual fund shares in their portfolio. So how did they get there? They got there through investing. So investing is very different from savings, where you open a savings account or checking account, or you have a CD in a bank, and then you pretty much leave it there. So again, we all know all these banking products have got low risk and they also have given us low returns. So, but if you really want to build wealth, you need to look on the other side, which is how to get ownership in stocks and bonds through investing. So, of course, while saving provides a foundation, investing takes your money to the next level by putting it to work and allowing it to grow. And we'll talk about how ownership in these products can actually help build wealth. So investing can involve buying securities such as stocks, bonds, mutual fund, etc. But again, these investments, you have to make sure because you are doing your due diligence, because they come with their unique risk and return properties. So successful investing needs discipline, patience, and long-term outlook. And we'll also see in the short term, these products may have huge volatility. The prices may go up and down, but in the long term, they have given a significant return to investors. So that's why investors should have a clear strategy and remain focused on their goals, regardless of market volatility or economic uncertainty. So let's move to our next slide. So the myths of investing. So the reason why I'm bringing this slide, because we have seen the top 50% have got large equity shares, but the bottom 50% have a very small portion of their wealth in equity shares. There's something which is kind of holding them back. So let's see what are those myths. You need a lot of money to start investing, and that is not true. That is not true. As we will see, you can start investing with very small amounts, even like $1, $2. So you really don't need a lot of money to start investing. Investing is too risky. As I told you, of course, each financial product comes with their own risk and return profile. But if you can manage it well, they are not so risky investments. And I can time the market. Of course, we all want to buy at the lowest price and sell at the highest price, but it's very difficult to predict when the stock will have the lowest price in the future. That's why you don't have to time the market, but it's all about being in the market. So what are the three keys to building wealth? So the three main factors that actually help you build wealth. The first is your size of your cash flow. So again, here, your savings component play a huge role. If you have small savings, of course, the less money will be invested. But if you have got large savings, then you can invest a larger amount. So of course, size of your cash flow makes a huge difference. So in the future, small, of course, amount invested will grow to a much smaller amount. But if you invest a larger amount, you can expect much more larger portfolio value. So size of your cash flow matters a lot when it comes to investing. And of course, timing of your investments. When did you start investing? And of course, we'll do a few calculations. I will show you how money grows and what, of course, we will see the longer you stay invested, the bigger will be your portfolio value. So that for that reason, the earlier you get started, the better will be your portfolio in the future. And rate of return, again, very important. So very basic concept in finance, risk is very proportional to return, or returns are very proportional to risk. If you are investing in a low risk, then of course you will get lower returns. But if you are investing in little higher risk, then you can expect higher returns. So again, it's very proportional. And how return matters, of course, small return leads to small portfolio value, and high returns leads to higher portfolio value. So having a little understanding about your own risk taking capacity, so that if you are a risk taker, then you can add a little bit more risk in your portfolio, and that will actually help pretty much build much more larger wealth in the future. So if there are any questions, I can maybe little take a pause here, and then if there's any questions, please feel free to put in a chat, and then I can take it from there. Looks like there are no questions, so let's move forward. So again, before we talk about the how timing can make a huge difference when it comes to investing, we have to first understand the concept of compound interest. So understanding compound interest is key to growing wealth, and of course, we'll see some calculations how compound interest can help you build wealth. So what is compound interest? Pretty much means the the interest earned in the previous year adds to your current year investing, and then pretty much you also earn interest based on your previous interest earned. So interest earned on both the principal and previous interest will be your current year interest. So again, the more you stay invested, the more previous year interest keeps on adding, and then you will see the much more larger interest earned in the current year. Unlike simple interest, it grows exponentially over time. And Albert Einstein called it the eighth wonder of the world. And once you have seen those calculations, even you will say, yes, that's true. So again, as you can see from the graph, of course, in the initial year, you don't see a huge growth, but then the moment you cross a certain, years, especially like once you have seen after 20 years, you will see your money compounding at much more faster rate. So it helps money grow faster over time, works best when you start early. And that's why to get the best or most benefit of compound interest, you have to start early. And small investments today can turn into big wealth. And of course, we will do some calculations. I'll have you scan a calculator, and then you can see how those wealth compounds with compound interest. So of course, this is not a math class, so I will not, ask you to kind of do all this compound interest, use a formula to calculate, the balances in the future. But this is how, it works. So of course, there's a formula. And then, of course, you can look at this years, 10 years, 20 years, 30 years, 40 years. And then that's your D. But then if you look at the formula, this is how your money grows. But here we are not going to use our calculations. We are going to use a TVM calculator. So can you please, if you have a phone or some device where you can use a camera and scan this QR code, and then we will look at this TVM calculator. So I will see if I can put this is a calculator. So if you can click on this link, you will see TVM calculator, or you can scan with this QR code. Okay, let's get started now. So we'll do a little a small mini case just to show you how investing early can make a huge difference. So starting early, the power of compounding. So we have got two situations here, or two scenarios. In first scenario, you are investing $300 a month for 40 years, and we are looking at 8% expected return. And in the second scenario, we are looking at investing $300 a month for 30 years. So you are starting 10 years later at 8% expected return. And of course, if I ask you who ends up with more money, and since I've given you some hint even in the previous slides, the earlier you start, the bigger your return. So as we'll see, the one who started much earlier, have got 40 years of investing, will have a much more bigger portfolio value. So let's look at our calculations here. So now that you have scanned your calculator, you will see TVM that looks like the one I'm showing you here. So here we are using mode and. Why I'm using and mode? As most of us have a job, we get our paycheck, and here we are assuming you're getting a paycheck at the end of the month. So you will deposit at the end of the month. So you are doing payments of $300 a month. So we'll put negative 300, means it's a deposit. And then our annual rate, which I mentioned earlier, we are looking at 8% expected rate of return. So we'll put 8 here. And then in our first scenario, it is 40 years of investing. So we'll put 40 here. So once we have done the data inputs, and then we look at compounding monthly. Why monthly? Because we are investing on a monthly basis. And then here's something called FV. And once you click on FV, you will see which is almost, which is over actually $1 million. So as you can see here, this is a first scenario. Now that you have got some hands-on experience working on this calculator, that just by investing $300 a month, and if we can expect 8% growth, and if we do it for 40 years, we are looking at over $1 million. So not a whole lot of money we are putting in to be a millionaire, but that's a math, right? So now look at the scenario 2, where we started 10 years later. So maybe you are, you started 10 years late, and then you're looking at same numbers, same deposits, $300 negative, means it's investing 8% annual rate, and now your periods are 30 years. And again, compounding monthly, and then you press future value, you're looking at only $447,000, which is a lot less than what you could have, you achieved when you invested for 40 years. So as you can see here, investing for longer duration adds a lot more in your portfolio value than investing for a much smaller period or starting late. So if there are any questions on this calculations, I'll be more than happy to answer. So let's continue. So just a more breakdown of those numbers. So in 40 years, when we invested $300 a month, we had a portfolio value of $1 million. But how much of your own money actually went into it? So if you do the calculations, $300 per month times 40 years, which is 480 months, that is only $144,000. So the interest earned, or what we call compounding, is actually over $900,000. So pretty much, as you can see, is almost 10x. And then when you do it for 30 years, you invested $108,000. Again, this is $300 times 360 months. And there's not a huge difference. As you can see here, 144 and 108 is a difference of only $36,000. But then your total portfolio value was only $447,000. And so the interest earned through compounding was only $339,000. As you can see here, by delaying for 10 years, you have almost lost $550,000 of interest earned, whereas as you can see here, the invested amount was only $36,000 less. So that's why when it comes to building wealth, the first thing when you get a job is think about retirement. Yes, retirement may be 40 years away and your paycheck is small, your rent may be high, and you may have student loans to repay, but saving even small amounts early on can make a huge difference. This is what we have learned from our previous calculations. It's a power of compound interest. It's important to start with what you can and be disciplined, increasing the amount automatically over time. And of course, this is something you can get started with whatever you can do it, and then you can always add more amount as you get a pay raise or your bonuses. It's always going to add more value in your portfolio. So any questions? If there's any questions, I'll be more than happy to answer. So if you have liked this concept, I would like to see some, thumbs up so that, it kind of helps other people to. Okay, let's get moving. Thanks. So now that we have talked about, how starting early can make a huge difference, now I want to give you a little bit of perspective on our risk and return. So what we call it, the 1% rule. Small growth, big returns. So when planning for financial future, most people ask, how much should I invest each month? Of course, the size of cash flow, as I mentioned, of course, plays a huge role. But then there's a far more powerful question. How fast is my money growing? And this is where your rate of return plays a huge role. Even a small 1% increase in your return can lead to dramatically different outcomes over time. That's a 1% rule, and it shows the compounding magic of just slightly better return. And that's why we have got so many financial products with their own unique risk and return characteristics. So before you make a choice where you want your money to, grow, in what kind of financial product, you should understand this. Even a 1% better return can make a huge difference. So scenario, of course, if you're looking at $300 a month, invested for 30 years, so the total invested amount is $108,000, and you'll be amazed how the 1% can make a huge difference. So if it was 7%, instead of doing 8%, your portfolio value would have been only $365,000 or 366, much closer to 66. And if it was 9%, that would have grown to almost $550,000. So as you can see here, the 1% impact. If you're comparing between 7 to 8%, that's 81% more. But if you're comparing from 8%, 9%, that's actually $102,000 or $102,000 more. So it's not linear. As you can see here, the high returns can make a huge difference. So you don't have double your contributions to double your wealth. investing more efficiently can make all the difference. So we may have first instinct like, okay, if I need more portfolio value, then I need to add more dollar amount. But as you will see here in the next calculation as well, in the next slides as well, it's about where your money is actually being invested in what kind of financial product. So if you can take a little bit more additional risk, you can expect high returns, and that additional return can make a huge difference. So now that we have learned some basic about how returns, even a 1% extra return can make a huge difference. Now I want to give you some historical perspective of how our two big financial products have achieved in the past. If you're looking at Great Depression, which is now almost 100 years back, how we have got those returns. So if you're looking at stock portfolio, stock, of course, we all know, we'll not go in detail, but it's a ownership in a corporation, and as the corporation grows, we see the stock price going up, and of course, it leads to higher returns. So if you look at the stock portfolio, pure stock portfolio, and going back almost 100 years, we have achieved over 9.59%. And this is one of the reasons I have taken around 8%. It was a little bit more conservative compared to what we have achieved in the past. But the bonds, which is again low risk, a little bit lower riskier than stocks. It's more about, you like a lender to a company, and you get a fixed, return in the form of, when the company pays interest or coupons, that return has been around 5.59%. So as you can see, it's a huge difference between 9.59 and 5.9%, 5.59, because it has a lower risk. And the balance fund, which is 60% stocks and 40% bonds, have given over 8.5% return over the last, these are all annual returns over the last 100 years. So just to give you some idea about how the returns have been in the last 100 years in our stock portfolio, bond portfolio, or in our balance fund. So that's why we can pretty much put all our financial products in a pyramid. As you can see here, the level 1, which is our financial security. So if you're looking at putting money in a cash account or CDs, certificate deposit, money market mutual funds, or US government bonds, all they have a characteristics of low risk. And that's why they are at the bottom of the pyramid, where you can expect much more lower returns. But then as you can add more risk in your, if you're a little bit of more risk taker, then you can think about going to level 2, which is again safety and income. So these are US securities, selected corporate or municipal bonds, income stocks, and conservative mutual funds. But if you are again a little bit of more risk taker, then you can take exposure in growth stocks, growth oriented mutual fund, and rental property. And again, as we are going from level 1 to level 2 to level 3, we are adding more risk, and we can expect higher returns in our portfolio. And level 4 is again speculation, where we can look at anything from Bitcoin to commodities, or anything into art, or coins, or whatever you can think about, which is private equity, or hedge funds. But these are all speculative investing. So, but again, much more higher risk, and you can expect higher return. So what a 4%, as I showed you, our stock portfolio was around 9.59, and our bond portfolio was 5.59. You may think, oh, it's not a big deal, it's just a 4%. But then if you're doing it for 40 years, just that 4% return can make a huge difference. So again, here I'm showing $300 a month investing for 40 years. The stock fund, of course, these are historical returns. If one had invested 40 years back and invested in a stock fund, and they'd achieved 9.59% annual return, that amount portfolio would be around $1.5 million. And bond fund, as we know, little lower risk and lower returns. And if someone had invested 40 years ago, $3 a month, their portfolio today will be around $515,000, almost 1/3. So even though you may think like, oh, it's just a 4%, but when it comes to your portfolio value in long term, the difference can be huge. So that's a difference of almost $1 million all from choosing higher growth investments over lower risk bonds. But again, since you're going to be investing for the future, and this is something I always say, these are again historical returns. So past returns are not guaranteed in the future. But if long-term trend continues, staying invested in a diversified stock portfolio could dramatically increase your wealth over time without increasing your monthly contributions. So if it makes sense, if there's any questions, I'll be more than happy to take some questions. And if you have liked it, I would like to see some thumbs up so that I can move to our next topic. So any questions? Okay, good. I see one thumbs up. Okay. Oh, good. Thanks. Let's move. So again, this is something we talk about a lot. Our rule of 72. Just to kind of sometime we want to get some idea about our how returns will be on impact of returns on a portfolio. So first thing we say, okay, how long will it take for me to double my money with that specific rate of return? And that's why we have a rule of 72. So again, as you can see with 1%, of course, if you are expecting 1% return, which is pretty much we have seen in our bank products such as savings, CDs, which are much more lower risk, and they also provide us a lower returns. So if you're getting something on 1% return, you will be doubling your money in 72 years. And again, if you're looking at 8%, which is something historically, the return we have seen in a balanced fund, that money will double in 9 years. But remember that inflation, which is again, as we know, can be a real, wealth destroyer. So with 3% inflation, your prices will double in 24 years. So if you're investing in a product which earns you less than inflation rate, you are not getting richer, you are actually getting poorer because you will have money that will not even buy what you could buy with your current money in the future. So pretty much whenever it comes to investing, think about inflation, that how inflation plays a huge role, especially in portfolio value. So you have to make sure you pick up product or financial product that gives a return which is higher than your inflation returns or inflation rate of inflation. And that's why again asset allocations can be a huge important, especially when it comes to creating a portfolio that especially as you are younger, you have got much longer time horizon. You can take a little bit more extra risk, and because since you are not something looking to cash in your early years, and that's why what we say, you can get into more aggressive allocation. So when we say aggressive allocation, means your portfolio has more stocks, less bonds, and even almost zero, much more smaller cash equivalents. But then as maybe your life situation changes or as you grow older, this is something you can consider rebalancing, where you can allocate more towards a fixed income and less in your stock portfolio. And then as you approach your retirement years, where your risk taking capacity is much more smaller, then you can add a lot more financial, your fixed income products, and you can reduce your stock exposure. And of course, you can also add cash equivalents. This is something, a lot of people get started with more aggressive portfolio. And as life situation changes, or, as you get older, you can rebalance your portfolio towards more conservative allocation. But this is something I just want to warn, because what we have seen, as you can see from the data, holding too much cash in your retirement account can hurt your future. And you'll be amazed that on an average, almost 28% of their portfolio is sitting in cash. So if they're earning very minuscule, like 1% or even less than, if it's 2% or less than inflation rate, it's actually not helping you to grow wealth, but it actually destroying your wealth. So while it might feel safe keeping a large portion of retirement saving in cash, such as money market or stable value fund, it can actually cost you in long run because your returns are less than inflation rate. Low returns, these cash equivalent often earn less than 1 or 2%, especially in retirement plans. With inflation historically averaging 2 to 3%, your money is actually losing purchasing power every year. So you have to be very mindful how much of your portfolio is sitting in products that's earning less than inflation rate. So $10,000, let's look at some numbers. Sitting in a cash for 20 years with 1% return and 3% inflation loses nearly half of its value in real term. That's like turning your $10,000 into $6,700 worth of purchasing power. So again, this is something I just want to bring it up because I don't want anyone to be holding a large portion of their wealth in cash or cash equivalents that's earning less than inflation rate. So one more last thing I'll talk about is having a long-term outlook. And now that we have seen, that the top 50% of households owning almost 97% of wealth. And one more key information which I also want to share is that they have been holding it for long term. It's not something they just bought corporate equities just maybe a few months back, and now their wealth has just ballooned, and that's why they're holding so much significant amount of wealth. No, they've been holding it for long term. And if you look at, wealth by generations, before we have seen households, but then if you look at wealth by generation, it's baby boomers who are holding the most amount of the wealth because they've been holding it for long term. And baby boomers, as we know, are age 60 plus. So the wealth is not, equal among all generations. It's much more larger in baby boomers. And again, it's the very reason that they've been holding it for long term. That's why a financial plan is very important. If you want to stay, if you want to have a long-term wealth, make sure you are staying invested for long term. So as the latest data illustrate, wealth accumulation, especially among seniors, is influenced by investment assets. As we know, there's pretty much we have seen corporate equities and real estate have been the two key, products that have actually helped build wealth. The significant wealth owned by the top 10% and the growing wealth gap between different age groups highlight the impact of long-term investing strategies and importance of financial planning for retirement. So, of course, as you step forward into this exciting new phase of life, do so with the confidence that you are well prepared to create a prosperous and balanced future. So, if our seniors, if our baby boomers have achieved, even we can achieve the similar results in the future. So again, I just want to kind of highlight again how wealth creation, is not just by putting, too much products or getting into high speculative, but if you have been a long-term investor, you will still be able to achieve your target, which is owning a wealth over $1 million. So just move over crypto. A record number of workers are becoming millionaires with their boring 401ks and IRAs. And we'll talk about some of these tax advantage accounts in our second part. Meet the newly minted millionaires next door. They didn't put all their money into Microsoft type stocks or that made them rich. They didn't take the chance of speculating with cryptocurrency. But many millionaires are government workers, civil servants, educators, military workers, managers, co-workers, clocking just like you, leaving at the end of the shift to run and pick up their kids from school, and many never earn six-figure salary. But they have been investing for 4 decades, long term, taking every dollar offered by the employer in matching retirement plan contributions. And they also don't cash out their retirement saving when they change job, which is actually very common. Many people, when they switch jobs, they cash out their 401ks, they pay taxes, penalties. This is something you have to be mindful. If you're a long-term investor, you have to roll over so that your previous employer funds can continue so that you can stay invested for 40 years or 30 years. And most importantly, they didn't let the pandemic or related economic problems or skittish investor scare them away from the stock market. And just a couple of success stories. So as we have seen, our baby boomers, senior citizens, they are holding significant amount of wealth. And one of the example is of Ronald Reed, the janitor who became a multimillionaire by retirement. And as you can see here, the job profile was not something he earned six-figure salaries. This ordinary guy amassed almost $8 million. So we're not looking at 1 or 2 million or 3 million. Here we are looking at example of amassing almost $8 million. And here's how he did it and how you might follow some of his ways. Ronald Reed, long life. He lived to 92, saw him doing many things that many financial experts recommend. Here's a close look how he got rich. He was patient. He lived below his means. He invested in stocks. He invested in dividend paying stocks. He aimed to buy and hold. He didn't retire early and he kept learning. So you would think that he's the only one with a success story. I have another one here. So a 96-year-old secretary amassed a secret 8 millions. Again, as you can see, the dollar amount is same. Here's how she did it. So Sylvia Bloom, a legal secretary who worked at the same firm for 67 years, quietly built a fortune of over 8 million during her lifetime. How did she do it? She saved diligently. Of course, size of cash flow, as I told you, plays an important role. Um, Invested consistently, and we'll talk about recurring investing plans, whether you're doing through IRAs or 401ks, but you have to invest consistently and lived modestly. She never flaunted her wealth, and even her closest friend and family were unaware of the financial empire she had built. So when she passed away at the age of 96, Sylvia did something extraordinary. She left the majority of her estate to charitable causes, including a 6.24 million donation to fund college scholarships for underprivileged students at the Henry Street settlement. So this is something you aspire. We have got success stories of people doing in the past. It's very not that difficult to replicate their success stories. And this is the end of our first part where we just kind of gave a pretty basic overview of how certain things you can do that can help you build wealth. So now we'll come back for a part two where I will talk about certain strategies that you can implement. And these same strategies have been implemented by some of our success stories that you can also replicate in your own personal life. So we'll take a little pause here. We'll come back in 5 minutes, I guess, and then we'll talk about our part two, investing strategies. Thank you so much, and hope to see you in the next part. Thank you. So welcome to our part two. We'll talk about some investing strategies. So again, as we know, we kind of went over some of those investing basic concepts such as importance of compound interest, how just taking a marginally higher risk that can give us high returns can make a huge difference in your portfolio value, and also why diversification is so also important when it comes to investing. So some of the strategies I would talk about is that you don't really need a lot of money to start investing. You can start with as little as $10 a day, or even you can go for much more lesser amount, even $1 a day. But the most key important point here is you need to get started. And then passive versus active investing strategies. What is passive investment strategy or active investment strategy, and why index fund and ETFs are becoming very, very popular, especially for beginners. So before I start talking about strategies, I want to talk about there are certain recent technology changes that have made our investing a lot more accessible for everyone. So first is understanding fractional share ownership. This is something which is pretty fairly new, which was not available 10 years before, but now this is available for every investor to implement. So if think about, if a current stock price is selling for $400, earlier you need to have the full $400 amount to buy one stock. But now, if you don't have that amount, if you just have $100, you can actually buy that stock. Of course, you will only get a fraction, which is 0.25. And of course, if the price is consistent or constant, you can make more successive investments like another $100 and get another fraction. So again, you don't need a whole stock price to make a purchase. You can invest with as much dollar amount you have. With starting with $1, of course, you'll get a fraction. With much smaller amount, you'll have a much smaller fraction. So buying a fraction of a stock share, allowing investments in high value stock with smaller amounts of money. So it makes expensive stock accessible to all investors, regardless of budget. And you can invest precise amount of high value company without the constraint of full share price. And the second improvement which has recently happened, which is zero commission trading. And that has actually helped us creating what we call as setting up a recurring investing plan. So now that you can start investing with as low as $1 or $5 or $10, and you can make more successive investments. So now you don't have to worry about paying commission for every single trade because the commissions are zero. So zero commissions trading removes transaction cost, enabling cost-effective regular investments ideal for dollar cost averaging. And we'll talk about what is dollar cost averaging in the next slide. It encourages smaller, more frequent investments, aligning with dollar cost averaging and mitigating market volatility. And of course, it also helps us in our long-term investing strategy. So it kind of helps us stay invested for long term. So this approach supports steady portfolio growth over time without the impact of trading fees. So as I mentioned to you that you really don't need a lot of dollar amount to start investing. So I want to show you an example of getting into trading or investing. I wouldn't say trading here, but setting up your investing plan with as low as $10 a day. And why did I pick $10 a day? Reason why, if you look at the economic value of $10 in today's time, it's really not a whole lot. So if you think about what kind of things you can purchase for $10. So if you're going for a movie, you're paying a lot more than $10. Even a restaurant meal, you're paying more than $10. Groceries cost more than $10. A car wash, pretty much in today's times, are costing around $10. A coffee, of course, if you're going out with a friend, you're paying a lot more than $10. So $10, that does not have a huge economic value, but if you can set up a recurring investing plan with $10, and if you can do it for 40 years, and in our simplest expected return of 8%, as you can see from a TVM calculator that we learned in our previous session. So if you're putting payment $10, which is -10, your 8% expected return, 40 years, you're going to stay invested, and then compounding daily. So that means you're investing on a daily basis. And if you do your future value, again, you're looking at over $1 million. So something that you can think about, not sacrificing a whole lot of your spending amount. What you can say, you are not really getting a whole lot of economic value, but the same $10, if you can invest for long term, can actually help achieve your target amount of $1 million. So now that you learned that you can somehow find a way to save $10 and invest. But the next question is where you want to invest. So as I mentioned earlier, ETFs are becoming a very popular strategy, especially for who want to begin with investing. So ETFs gives you a benefit of what we call a diversified portfolio, at the same time low cost. Because again, we want that if you want to build your portfolio, the most money that you're going to grow stays with you. So the fees, which is again, it's taken out from your investments every year. If you go for a low cost, then more money stays with you. So diversification, of course, we know most ETFs follow a benchmark. It could be S&P 500 or Russell 2000 or Russell 100, NASDAQ 100. So these are all ETFs that have a much more wider or much more large number of stocks. So they give a good diversification. So ETFs allow investors to own a broad range of assets such as stocks, bonds, or commodities without a single fund, reducing risk. And of course, low cost, which is a very big advantage of ETFs. ETFs typically have lower expense ratios compared to mutual fund. When we say mutual fund, means active mutual funds, where there's a portfolio manager. Since they are passively managed and trade on exchanges like stocks. Excuse me. So one of the example of ETF is S&P 500 index fund. So again, as the name, as you can see here, it's S&P 500. So we know there are 500 stocks in this fund, and it's very well diversified. There are around 11 sectors, and these sectors are pretty much across healthcare, financial services, consumer services. Think about any large technology, and you will see pretty much a large US stock company is in this fund. And some of the names, as you can see from the tickers, which is AMZN, Amazon, APL, Apple. So these are all large US companies, and the market cap is over $10 billion. So these are not something name which we have not heard of. These are all well-known names. So when you get into S&P, you are actually getting your exposure in all large US company. And pretty much S&P is also a proxy for a US stock market, and pretty much and around 86% market cap is pretty much in our S&P 500 fund. And I think one sec. So recurring investing plan, as I told you, you can set it up. It's not that difficult. Many brokers, if you look at some of the well-known names like Vanguard, Charles Schwab, Robinhood, Fidelity, they all provide an option to, excuse me, set up a recurring investing plan. So recurring investing plan allow investors to make regular contributions to their investment accounts. Contributions can be automatically deducted from a bank account or paycheck. Give me one second. So these plans help investors save for long-term goals such as retirement, and regular contributions can take advantage of dollar cost averaging, reducing the impact of market volatility. Broker firms offer recurring investment plans, sometimes reduce fees or commission-free trades. And some plans allow automatic contributions increases as income grows. So I had mentioned briefly about dollar cost averaging. So what is dollar cost averaging and why it is so important, especially if you are a long-term investor? So think about, I would say, when we all know stock market is pretty quite volatile, prices goes up and down. But if you have set up a recurring investing plan, for example, $10 a day, your plan is going to buy a stock worth of $10 every day. So this is an amount which is fixed, and your fraction of ownership will change based on the stock price on that particular day. Think about you decide to spend $10 on apples. There's something, a hypothetical example here. And you go to a store and it says, one apple, $2. And then you can get 5 apples for that $10. So next day you go to the store and it says price reduced, apple is now $1. So now you can buy 10 apples. So as you can see here, when the prices are lower on stock price, as you can see here from the chart, you are actually going to buy more apples. And what we have seen on an average, if you are recurring investment plan, your average prices are going to be much smaller than you are going to make purchase on one single time. And another thing which I want to really bring it here, along with your, one of the key example of dollar cost averaging is your dividend reinvestment plan. So if you're a investor, and we all know companies pay dividends, and if you decide to reinvest your dividends, you are taking advantage of dollar cost averaging. So again, reinvested dividends generate additional income, accelerating portfolio growth. And regular reinvestment dividends also help mitigate market volatility by buying more shares when prices are low. And then your dividend reinvestments also increase ownership in the company or in the fund. So just a key numbers here. So without dividend reinvestment, and we're looking at last 40 years of this S&P data, your $1 would have grown to $9.92. But with dividend reinvestment, the same time period, if you had included dividends, your $1 would have grown to $27.79. So huge advantage of reinvesting your dividends. So please do consider reinvesting when it comes to setting up a long-term plan. So the three biggest mistakes, I want to bring it up here. Panic selling, which we have seen a lot, especially when the markets are down. We tend to ignore our long-term plans, and we always end up selling our portfolio. That's why we need to always have a plan when it comes to investing, so that if you're investing for long term, you stay invested for long term, ignoring any significant market downturns, because your plan is to stay invested for long term. And of course, fees, as I told you, can play a huge role in our portfolio value if you are a long term investor. So that's why one key when it comes to investing is diversification, because we may spend hours and days trying to find a stock that we think is going to be the one stock that's going to make you rich in your portfolio, or maybe rich in retirement. But then, as we know, technology changes, things changes, economic environment changes. Today's best company may not be tomorrow's best company. That's why it's important to diversify as much as possible. And again, keep a close eye on fees. So what kind of financial products you are investing in can make a huge difference. So if you are going with a much more expensive fund, with an active portfolio manager with a high expense ratio, it's going to have a big impact on your portfolio in the future. So try to minimize your fees as much as possible. And again, stay the course. So investing is not something you are doing it for short term. It's a very long-term goal. So markets goes up and down. So if the markets are down, all you do is you pretty much ignore the volatility and stay invested. So retirement especially is a long-term goal, investing it for long-term process. Stock prices go up and down all the time. But for those who remain committed, have historically experienced higher returns. So don't give it a knee-jerk reaction, practice patience and stick with your plans. So this is a chart I want to show you just to kind of reinforce what I just told, how staying invested. And I also showed you in a previous example, move over cryptos, how workers have become millionaires. And one of the secret sauce was they stayed invested and they didn't let any, economic downturn or anything that led them, sell their portfolio. As you can see here, and they've been well rewarded. So the blues are the one when we had a boom where the markets were growing, and then of course it's called bull market, and then we have a bear market where markets drop due to the economic recession. And what we see from the graph is we had much more longer bull run than compared to bear run. And this is over the time it's a log chart, and we have seen a much significant growth if we have been holding for the long term. So the average bull ran for about 6 years, delivering an average return of over 200%. But the average bear only lasted for 15 months, and the loss was only 38.4%. So if you're a long-term investor, you always get rewarded by holding it. And just want to show you this chart, even when the markets, as you can see from this significant day, one of the day where the entire markets, as you can see here, was in the red. So pretty much, you will come across these situations. So selling stock during downturn is only advisable if one can predict the prolonged market decline, which is rare and often based more on luck than skill. If it's someone, I don't think so anyone has a crystal ball that will give a very clear, idea of how long this downturn is going to stick around. That's why it's always good to stay invested. And again, the fee, which I mentioned about, they can take a big bite of your money. So be cognizant of the expense ratio which is being charged on your, on your fund. As you can see here, a 2.5% fee means you end up with less than half as much you would pay with no fee. A 1% fee may not sound like a lot, but it costs you thousands over time. So of course, lower fees means more money for you. So whenever you pick an investment, whether you are doing in your Roth IRA or traditional IRA or in your 401ks, if your company offers, make sure what kind of fees are being charged in your fund. So now that we have learned about important diversification, getting through ETFs, low cost, staying invested, I just want to reinforce through this book. So the Bogglehead's Guide to Investing. Choose low-cost funds. Opt for mutual funds or ETF with lower annual fees to preserve your investment returns. Consider index funds or ETF. These funds aim to replicate market indexes and generally have lower expenses than actively managed funds. So first thing, whenever it comes to investing, you should always consider ETFs over active mutual funds because first one reason, they have got lower fees. And just want to share some investing lessons from Warren Buffett. We all know he's our investing guru who has been investing for decades. So Warren Buffett cautioned against individual stock picking, stating that most people cannot successfully pick stocks. So, we may think that we have skills that will help us pick one stock, but unfortunately, it's very difficult to predict that will stick around for long term. Buffett recommend investing in low-cost index funds, particularly the S&P index fund for long-term growth. He emphasized the historical performance of American corporations and the benefits of diversification. And Buffett warned against treating the stock market like a casino and expressed concern about the rise of gambling behavior among retail investors. So again, huge difference when you want to use your stocks or securities either for short term, which is trading, or for long term. So if you're a long term investor, then it's much different than doing a short term trades in your portfolio. He encouraged a long term investment strategy and discouraged excessive trading. And the second part of Warren Buffett's recommendation is using dollar cost averaging. So the first, we learned about, which is setting up a recurring investing plan. So of course, if you have a 401k through your employer, that's automatically your recurring investing plan because every month, your funds get deposited and your funds buy investments and it kind of sticks around for many, many years. It's all recurring and you're getting benefit of dollar cost averaging. But if you're doing your own investing through brokerage, either in a regular brokerage account or in tax advantage such as traditional IRA or Roth IRA, then it's advantages to set up a recurring investing plan and take advantage of dollar cost averaging. Buffett has long preached that you don't need a portfolio of 100 individual stocks or expensive mutual funds. You only need an S&P 500 index fund. So regarding investing for retirement, Buffett told CNBC that investors should consistently buy a S&P 500 low-cost index fund, and that he thinks is the right thing to do that makes the most sense practically all of the time. And bear markets, as I told you with dollar cost averaging, when the markets are lower, and if you are setting up a recurring investing plan, your fixed dollar amount will end up buying more units. Or if you want to get started, of course, you can time it, wait for some of those markets time period when the markets are down. Again, that's one of the strategy will get you more units for that dollar. And bear markets may be the perfect time to increase or begin your S&P stake. Keep buying it through thick and thin, and especially through thin, Buffett added. And now that we talked about some, our investing basics and strategies, like setting up a recurring investing plan, going through index funds, and staying the course. Now that we have seen even small dollar amounts, even getting into investing with as low as $10 a day, and if you can get into a portfolio, even our S&P index fund, which has historically given over 10% in the last 40 years, not that difficult for any investor to replicate some of the success stories what Warren Buffett has just told us. So being a millionaire is not that difficult if you can replicate, and we have seen those examples even through our Ronald Reed and Sylvia Bloom. So if you weren't born rich but you dream of getting there someday, good news, dreams do come true. According to Millionaire Next Door, 80 to 85% of current millionaires are self-made. So again, this is a very key, and this is the reason I highlighted it, that it's not something they got the wealth through estate plan or to inherited, through their grandparents or their parents. They became millionaire by doing things the right way, and the right way we just talked about. First generation rich people often save their way to wealth through discipline, restraint, and small spending. Again, the size of cash flow matters a lot. So, one of the goals should also be as part of investing is, increase your savings so that you can invest a much more bigger amount. So, according to Million Next Door, self-made millionaires tend to know how much they spend on food and other household expenses every month. So, tracking expenses is very key when it comes to your, enhancing your size of cash flows when it comes to investing, and tend to not to spend a lot of money on expensive clothes. So, now that we have kind of talked about, how savings can play a huge role, and these are few things I recommend. First thing is track your expenses. If you want to have a big, you have to know where your cash is going in the first place. So maintaining a budget, your expense sheet, where you can track, how much, coming in and going and what kind of buckets, again, plays a huge role in enhancing your savings. And automate everything. So, sometimes we forget to make our credit card payments, we end up paying fees. And then, of course, it also hurts our credit scores. So when we take a loan, we end up paying higher interest rates. So just to make sure we can resolve all this, later issues, automate as much as possible. Whether you are investing, whether you are paying your bills, whatever you want to do, try to automate as much as possible. So sending your money directly from your checking accounts or paychecks to investment accounts, saving accounts, credit accounts, everything should pretty much be automated so that you don't fall in those gaps of missing any payments. And start with one small change. The key to saving half of your income is start with a small cuts. Don't try to change yourself in one go. Make steps, maybe starting small, and then you can pretty much take it from there. So cutting out a $5, if you are one of those person who drinks coffee every day, buy it. Something can make it at home. That's a good thing, good place to start. And monitor your progress, looking at the net worth every day. Like, net worth is pretty much your assets minus liabilities. So if your assets are growing, your liabilities are decreasing, your net worth is going up. So make sure you're keeping also track of your net worth as well. And change your mindset. You won't get very far without the right mindset. Committing to saving big starting now. And once you have got your big savings, of course, you can use those savings to invest. So again, final thoughts and action plan. Take advantage of compound interest by starting now. So, of course, the best time to start investing was yesterday, but since you have come today, you have learned about investing today, the second best time is today. So now, if you haven't done it so far, today is the best day to start investing. And automate your investments for consistency. Always, set up a recurring investing plan so that you are not missing on any of those investing days, taking advantage of dollar cost averaging, and then stay patient and let time work for you. So as we know, with compound interest, the biggest benefit comes in your later years. So if you start early, you stay invested, you will see the benefit of compound interest in 30 years and 40 years period. So this is just a seminar which I'm doing, but I'll be also launching a course on investing that will be much more elaborate, where I'll be talking a lot more about retirement strategies using some of the accounts, how you can maximize benefits in your IRAs, Roth conversions, 5 to 9 college saving plans, how to maximize your 401ks through matching incentives. So again, using effective saving strategies and building good credit scores through credit management. This is something I'll be launching soon. So if there's any interest, just let me know, or some topics that you feel like you need me to incorporate. I would like to get your feedback as well. So this is something I would want you to kind of participate. Just let me know what topic you think are more valuable, of course, from your own experience or talking to your friends, and I'll be more than happy to incorporate those topics in the course. So in the course, I'll be covering strategies, deep dive strategies, personal guidance also, and also tools and community support going forward in this platform.